Welcome back to another episode of Freedom Finance with Lanny, guys. Appreciate you guys for stopping by. Lately, a lot of my investing videos have been focused on simplifying my stock portfolio, simply because there's been a lot going on in the lead up over the last 15 years of investing. So hopefully me simplifying my portfolio can help you as you try to either A, simplify your own, or B, if you're just a beginner investor and you're like, hey, how do I have a simple portfolio? What are some mistakes or things to avoid? You've come to the right place, guys. Again, it's all about pursuing financial freedom here on this YouTube channel. And this video is going to be about possibly some more cleanup I'm doing in the stock portfolio, guys. So get ready. I've got 5 more stocks that I'm talking about that I might just have to bring out the brooms and sweep them out of the portfolio. So grab your favorite beverage, guys. Your beer, your liquor, your wine, because you're Italian and it's the weekend, baby. Get your coffee, your espresso if you'd like. Come rock with me, guys, and let's check out how I'm looking to further simplify the taxable stock portfolio. Let's get it. All right, guys, so you might remember a couple videos ago where, I kind of told you my mistake, owning over 70 individual stock or exchange traded, aka ETF investments in my taxable stock portfolio, guys. In fact, I actually had 74 positions. Pick the jaw up. Yep, it's true. 74 different ticker symbols spread across my nice portfolio spreadsheet where I track all my stocks and every single account, the passive income, the dividend growth, et cetera, et cetera. In my taxable account, 74 freaking different positions. Talk about going mad. You know how many 10Ks, 10Qs, press releases, earnings releases that I'm reading? Too many to count for this CPA over here, guys. And in that video, I actually talked about 6 stocks and, including one ETF that I was looking to clean up. Well, guys, the deed is done. I did end up selling those 6. So check out that video to see what those 6 were. So I went from 74 positions down to 68. Well, guys, batter up because I've got 5 more stocks that I have in my portfolio that essentially I'm looking to clean up here, guys. And the whole goal here is to find better use of the capital that I think could be better use of the capital right now. Again, we're focused on not just, capital preservation obviously is key. You'll find a stock or two on here that has destroyed that. 2, give me some growth. It doesn't need to be this firecracker, NVIDIA or some AI-centric stock, but give me some returns that correlate to the overall stock market, or at least better than what these stocks have been doing. And because I'm a dividend investor trying to, create passive income, there has to be some sort of passive income stream, A, and then B, an income stream that grows. So capital preservation, some sort of capital appreciation, dividends, dividend growth. Those are kind of like the big factors here for why I'm looking at these 5 positions. And, I'll have to really think about, what positions would I move this capital into? That's key, guys. A lot of these stocks I've owned for quite some time. A lot of these stocks could have been part of a spinoff, from other stocks that I've owned. Heck, one of these stocks could be the stock that gave the spinoff, and the spinoff is also on this list. Talk about, a cluster F right there. And some of these stocks have actually performed well. But it's more of, hey, is it right for my portfolio? Is this what I want to hold? Some stocks may even be a small position. I call a small position for me less than $1,000. For you, it might be different. It might be 500. It might be 5,000. It might be 10,000. But for me, I consider a small position less than 1,000. After 15 years of investing, that's kind of where I'm at right now. So we're going to talk about the 5 stocks, guys. We're going to talk about each ticker, how much market value, what gain or loss position I'm in, how much dividend income do I stand to lose, and has there been any dividend growth over that, historical time period. So the first stock right here, guys, is going to be Dow Chemical. Ticker symbol is Dow, D-O-W. Yes, Dow Chemical. We all have probably somehow heard of this chemical company. They went through a lot of stuff over the last 5 to 10 years. Dow DuPont, when they merged together. And then they all split off into 3 companies, Dow DuPont, and Corteva. So Dow is a standalone stock right now. Currently I own almost $1,700 worth. And the stock yields pretty well, provides me a 5% passive income boost. So it provides me $84 in income. I'm sitting at a long-term capital gain of about $213. Now, the strange part about Dow, the 5-year return's only been 16%. Not good. Not terrible, but not good. And dividend growth has been 0%. So that's why it's on the chopping block for me. Though it carries a high yield, the appreciation over the 5 years hasn't done much, and they haven't really grown their dividends. So to me, if my income's not growing, not a fan. Second stock is actually that third spinoff company I just talked about, Corteva, C-T-V-A. Again, nobody's probably ever heard of this stock. Do you own it? Did you own Dow DuPont upon the spinoff and got CTVA? Let me know in those comments, guys. So the reason why this stock is on the chopping block isn't because of the return. I mean, we're talking 89% return since I've held it. My realized gain right now would be $1,000. So I'd be facing a pretty big tax hit, possibly. $1,000 realized gain. It does pay a dividend, but it's at 1.17%. So this is why I'm trying to possibly exit Corteva. The PE is actually high. It's at around 19 to 20 times earnings. So to me, that's pretty high in that space. And the yield at 1.17% is only as good if there's also some dividend growth with it. Now, the dividend growth the last increase was 6.67%. So the combination is actually still below 8%. And to me, that's just not enough if you're yielding barely over 1%. This, if that makes sense. What do you guys think? So that's Corteva. Again, provides me about $15 in, income. I own about $1,400, and $1,052 of that is in a realized gain spot. So that's stock number 2 on the chopping block. Now, I had that big gain, right? That could be a big gain that I'm going to face. Well, stock number 3 could wipe that up real quick, and that is Warner Brothers Discovery, or Warner Media Brothers Discovery, whatever the heck you guys want to call yourselves right now. WBD continues to tear down my capital. Loss of capital, not preserving capital here. I own $585. I bet if you talked to me a couple weeks ago, that was probably at $700. You talked to me about a couple months ago, it was probably at $1,000. So I'm losing capital month by month right now by holding this crap. Yes, crap. And the earnings was just like that. Crap. I'm actually in an unrealized loss since the spinoff from AT&T of $1,600. So Dow and Corteva combine almost $1,300 of a realized gain. This sitting at a $1,600 realized loss would take care of all of it. Boom, bang. Thank you. No dividend, no growth, and down 65% since the stock has been public. So terrible. Now the question here is though, is this the bottom? Is there going to be some sort of upside here with WBD? You guys let me know what you think. Should I sell this stock or should I wait for the big upswing? Should I wait for a merger? Next is NetApp, NTAP, N-T-A-P. I only own $255. They pay 2.29%, $6 in dividends. No dividend growth, up 32% the last 5 years, and an unrealized gain of $187. So most of my positions in a gain, the reason why I just don't want it is because it's so small. Why hold on to it? It's not going to balloon up to 20 grand by any means. So that's why I'm going to exit it. Plus there's no dividend growth. So lack of dividend growth, smaller yield with no capital appreciation. That's even half of the S&P 500. That's why it's on the chopping block. The fifth stock's actually interesting. Citizens and Northern, a nice community bank in Pennsylvania, New York. CZNC, and I own about $776. It yields over 6% actually, so it provides $47 in dividend income for me. It's actually down 30% over the last 5 years. Spotty dividend growth, no dividend growth recently. Obviously, banks haven't really been doing that as much as they used to. I'd be at an unrealized gain of a couple $100 here with Citizens and Northern. So that's what I'm trying to figure out right now, guys. And in fact, I have to make a correction. I have $385 of net app. And with Citizens and Northern, I earn about $1,244 right now in income or in market value for Citizens and Northern. Net right now, we're talking $5,258 in capital, $184 in dividend income that these 5 positions pay me. That's a yield of 3.50%, smack even, 3.5% yield on this money, on these 5 positions. And I'd be in a net realized loss of $14 if I sold them all, almost a clean sweep exiting these 5 companies. And again, keep in mind, 2 stocks have tremendously underperformed, losing capital from a stock price standpoint over the last 5 years. Now, Citizens and Northern I've held for a long time, plus dividend investment. And that's why I'm in a realized gain on them. But Citizens and Northern down 30% the last 5 years. WBD down 65%. And then you have Dow up 16%, NetApp up 32%. Corteva is the winner at 89%. Now, I could clean it out, right? But then you really have to know your next move. We all know I love Vanguard's VOIM. It yields a little over 3%, so that's solid. I do love my Vanguard Dividend Appreciation ETF VIG, and of course there's VOO. Now, none of those touch this 3.5%. And we're kind of at near all-time stock market highs right now. There's also Main Street Capital that yields 6.3, 6.4%. Ticker symbol is MAIN, the monthly dividend payer, the business development company. So there's also another option there to maybe grab some of that yield that I would lose from Citizens and Northern and Dow. Albeit Main Street returns back to the shareholders, returns better than Dow, returns better than Citizens and Northern, increases their dividend, as well as issues usually a nice special dividend almost every single quarter. So that's kind of what I'm mulling right now. These 5 positions, if I exit, I can go down from 68 to 63 spots and get closer to the goal of being below 60, at least this year is kind of like the lighter goal, but if I can get even better than that, I will. So what do you guys think? Should I exit these 5 stocks? Should I clean house and try to find some better use of the capital? What would you guys do in my situation? And do you own any of these stocks here that I've mentioned here during this video? Let me know if this helped you. Hopefully this kind of makes sense. Hopefully this might help you on your simplification of your personal finance on that financial freedom journey that you're on here, guys. It's all about growing wealth, growing that passive income, and getting to that promised land, guys. So like this video, subscribe to this channel, and thanks for rocking with me. I'll catch you on the next one.